How does a company report 15 lakhs crore rupees in revenue without anyone noticing something is wrong? It starts with a single email, not from a regulator, not from an auditor, not from a hedge fund, but from an ordinary shareholder who noticed something that thousands of professional analysts apparently missed. That one observation about unpaid customer dues eventually leads India's market regulator into a corporate structure spanning three countries, allegations of fabricated transactions, and a revenue figure so large it exceeds the earnings of India's biggest company. This episode is not about proving guilt. SEBI's findings so far are allegations contained in an interim order, and the company has the right to respond before any final conclusion is reached. What this episode is about is something more unsettling than one company's alleged wrongdoing. It is about how easily a number can be made to look real, how rarely anyone checks it, and what that means for every person who has ever trusted a financial statement to make a decision. Welcome to the IPN.Gate Podcast. I am Zayd Haji, author, research student, management consultant, and counselor. Every week on this show, I take something happening in the real world and pull it apart until the hidden mechanics are visible, because I believe the things that shape our financial lives are rarely explained in a way that respects the listener's intelligence. Today's story involves a company most Indians have never heard of, despite it being one of the largest gold processing businesses in the country. It involves a regulatory filing that alleges revenue manipulation worth more than 15 lakhs crore rupees, a number so large it is difficult to hold in your head. And it involves a lesson that applies far beyond gold or India or even the stock market, because it is really a story about what happens when the people meant to check a number simply do not. Let's get into it. I want to start with a question that sounds simple but is not. When you look at a company's revenue figure, what are you actually looking at? Most people assume it is a fact, something verified, something solid enough to build a decision on. According to SEBI's interim order, that assumption may not have held for a company called Rajesh Exports. And understanding why requires going back to where this company began. Rajesh Exports was founded in 1989 in a garage in Bengaluru, started by two brothers, Rajesh Mehta and Prashant Mehta, who took over their father's small jewelry trade. The early business was straightforward: refine gold, manufacture jewelry, sell it. Within a year, they had opened a retail unit, and within a decade, they had built a serious manufacturing base. By 2015, the company had grown enough to acquire Valcambi, a Switzerland based refinery widely regarded as the largest gold refiner in the world, at a valuation of $400 million. Here is where I want you to pay attention, because this detail becomes important later. At the time of acquisition, Velcambi's own revenue was roughly 2.5 lakhs crore rupees. Rajesh Exports paid approximately 2800 crore rupees to acquire it. That gap between what the target company earned and what it was purchased for is not by itself evidence of anything improper. Acquisitions are priced on many factors beyond revenue, but it is a number worth holding on to as this story develops. From there, the company's reported revenue grew into figures that are genuinely hard to process: 2 lakhs crore, then 3 lakhs crore, and in the most recent financial year, over 7.5 lakhs crore rupees. On the surface, this looks like the trajectory of a business becoming one of the most dominant players in its industry, and institutional investors treated it that way, with LIC, one of India's largest institutional investors, holding a position in the stock. But here is something the gold refining industry teaches you that most other industries do not, and it matters for understanding everything that follows. In this business, revenue and profit are not close cousins. If you buy 100 rupees of gold, process it, and sell it for 101 rupees, your revenue is 101 rupees, but your actual profit is 1 rupee. Refiners essentially pass through the value of the metal itself, earning only a thin margin on the processing. This is source supported context, not speculation, and it explains why a gold processing company can report revenue in the lakhs of crores without generating anything close to that in profit. I am telling you this not as a footnote, but as the key that unlocks the entire controversy, because the difference between a legitimate thin margin business and an allegedly manipulated one often comes down to a single question: is the money actually coming in? That question, whether the money was actually coming in, is exactly what one shareholder asked in March 2024, and the answer he found sent an email to SEBI that would eventually unravel a corporate structure spanning 3 countries. In part 2, I want to walk you through what SEBI found when it started pulling that thread, because what emerges is not just a story about one company. It is a story about the auditors who signed off, the ratings agencies that stayed quiet, and the uncomfortable question of who is actually protecting your money when you invest it. On March 11, 2024, SEBI received an email from a shareholder who had gone through Rajesh Exports' financial statements in detail. What he noticed was that the company's trade receivables, the money customers owed but had not yet paid, had been sitting unpaid for 2 years. If you have never dealt with this term before, here is what it means in plain language. If you sell someone 1 crore rupees of gold and they take the goods but promise to pay later, your books record the sale and the revenue immediately, even though the cash has not arrived. That unpaid amount is a trade receivable. A short delay is normal in any business. A 2 year delay is not, and it raises a reasonable question, which is whether the business is struggling or whether the revenue being reported was ever fully real to begin with. That single observation prompted SEBI to start asking Rajesh Exports for documentation, including customer lists, sales invoices, vendor details, and subsidiary records. According to SEBI's order, what came back was incomplete, and that incompleteness is what pushed the investigation from a narrow question about receivables into a full examination of the company's corporate structure, which stretched from India through Singapore into Switzerland. What SEBI alleges it found between 2020 and 2025 is that the Rajesh Exports Group reported close to 15 lakhs crore rupees in revenue, with 99% of it attributed to overseas subsidiaries that SEBI says it could not independently verify. And here is where that earlier detail about Welcamby becomes relevant again. At the group level, the company was reporting revenue in the lakhs of crores. But when SEBI examined Valcambi's own standalone financial statements, the subsidiary's actual earnings were only around 5 to 700 crore rupees. The company's explanation, according to the order, was that Valcambi records only its processing income, while the group level figures include the full value of the underlying gold. That explanation is theoretically plausible, and I want to be fair to that possibility. But SEBI states that the documentation needed to reconcile that gap was never provided. SEBI also flagged transactions worth roughly 23,000 crore rupees with a company called Affluence Shares and Stocks Private Limited. When contacted, that company reportedly told SEBI no such transactions had occurred and that Rajesh Exports was not even a client. Separately, SEBI's order notes that around 7.5 crore rupees moved from company funds into Chairman Rajesh Mehta's personal account, allegedly used for derivatives trading, without board approval or disclosure on record. I want to be precise here because precision matters more than outrage. This is an interim order, not a final finding of fraud. The company retains the right to respond, submit further documentation, and contest these findings. And Rajesh Mehta has been doing so publicly. My interpretation, and this is opinion, not fact, is that the real damage here may not be legal but psychological. If retail investors, LIC, and multiple foreign institutional investors were all relying on numbers that auditors and rating agencies apparently never meaningfully challenged, then the failure is not confined to one company. It is a failure of the entire verification chain that ordinary investors assume is protecting them. The company's share price has already fallen from around 800 rupees to roughly 100, with profit margins compressing below 1%, which the market has clearly registered as a loss of trust. The lesson I keep returning to is this: a number on a financial statement is not a fact until someone independent has actually checked it. And most of us, myself included, have spent years assuming that checking already happened before the number ever reached us. That assumption is comfortable, and this story is a reminder of how much it depends on people doing their jobs quietly and correctly long before we ever see the result. If this episode changed how you think about the numbers you trust, follow the IPN.Gate podcast so you do not miss what we uncover next. Thank you for listening, and I will see you in the next episode.